In a market defined by relentless volatility and high-stakes positioning, Bitcoin has once again captured the attention of investors worldwide as it plunges below the critical $77,000 threshold, sparking intense debate over whether this latest downturn represents nothing more than the final shakeout before a monumental upward surge. Welcome to Crypto Hub, your trusted source for in-depth professional analysis of the cryptocurrency landscape, where we cut through the noise to deliver clear insights grounded in market realities, on-chain data, and macroeconomic trends. Today, we examine this dramatic price action in Bitcoin, exploring the forces driving the decline, the historical parallels that suggest resilience, and the substantial evidence pointing toward a powerful recovery on the horizon. The cryptocurrency market opened the week on a somber note, with Bitcoin sliding beneath $77,000, reaching levels not seen in roughly 3 weeks and triggering over $580 million in leveraged liquidations across major exchanges. This move comes amid a confluence of pressures, including rising oil prices tied to geopolitical uncertainties, elevated Treasury yields weighing on risk assets, and lingering concerns from recent escalations in international tensions that have rattled investor confidence. As Bitcoin dipped to approximately $76,500 before stabilizing near the lower end of its recent trading range, altcoins followed suit with notable declines in assets like Ethereum, Dogecoin, and Bitcoin Cash, underscoring the interconnected nature of the broader crypto ecosystem. Yet amid this apparent turmoil, seasoned observers recognize familiar patterns that have preceded some of the most significant rallies in Bitcoin's history. This is not unfamiliar territory for a maturing asset class that has repeatedly demonstrated its capacity to weather storms and emerge stronger, rewarding those with conviction while testing the resolve of others. At Crypto Hub, we believe in approaching such moments with measured professionalism rather than panic or euphoria. Bitcoin's drop below $77,000, while painful for short-term holders, aligns with classic shakeout mechanics observed across multiple market cycles. These events serve a crucial purpose. They redistribute coins from weak hands to stronger long-term participants who understand the underlying value proposition. On-chain metrics provide compelling support for this view. Long-term holders continue to exhibit remarkable steadfastness, with exchange balances hovering near multi-year lows, indicating that seasoned investors are not rushing for the exits, but rather accumulating or simply hodling through the noise. This behavior contrasts sharply with the vulnerability of more recent entrants whose leverage positions have been flushed out, creating the very liquidity that often fuels the subsequent rebound. Data from leading analytics platforms reveals that underwater short-term holders are the primary source of selling pressure, while the broader supply dynamics suggest that available Bitcoin for immediate sale is tightening considerably. To fully appreciate the current situation, it is essential to contextualize it within the larger macroeconomic and regulatory environment shaping cryptocurrencies in 2026. Geopolitical developments, including statements from U.S. leadership regarding potential conflicts and their ripple effects on energy markets, have contributed to heightened volatility across risk assets. Rising oil prices introduce inflationary headwinds that central banks must navigate carefully, while climbing Treasury yields reflect shifting expectations around monetary policy and fiscal discipline. These factors have temporarily overshadowed positive crypto-specific catalysts, yet they do not negate the structural bull case that has been building for years. Institutional adoption continues its inexorable march forward, with Spot Bitcoin exchange-traded funds demonstrating robust infrastructure despite periodic outflows. Projections for the remainder of the year indicate that corporate Treasury allocations to digital assets could exceed $250 billion, a testament to the growing recognition of Bitcoin as a legitimate store of value and portfolio diversifier comparable to gold. Major financial institutions are not merely dipping their toes, but integrating crypto into core strategies, supported by clearer regulatory frameworks that reduce uncertainty and invite broader participation. Consider the impact of legislative progress such as the Digital Asset Market Clarity Act, which delineates roles between regulatory bodies and provides much-needed certainty for market participants. This development, combined with the expansion of crypto-linked financial products, positions the industry for accelerated maturation. Analysts anticipate that over 100 new crypto-related ETFs could launch in the United States alone during 2026, with these vehicles potentially absorbing more than 100% of newly issued supply for leading assets, including Bitcoin. Such demand-side pressure, when juxtaposed against Bitcoin's fixed supply cap of 21 million coins, creates powerful fundamentals that dwarf short-term price fluctuations. BlackRock's iShares Bitcoin Trust and similar products have already amassed tens of billions in assets under management, drawing capital from traditional wealth channels and signaling a permanent shift in how sophisticated investors allocate resources. Even as Bitcoin tests lower supports around $75,000 or $74,000 in the near term, these institutional inflows act as a formidable backstop, absorbing selling pressure and laying the groundwork for renewed upward momentum. History offers instructive lessons for those willing to study it carefully. Bitcoin has endured numerous shakeouts throughout its existence, from the dramatic corrections following previous all-time highs to the prolonged bear markets that tested community resolve. Each cycle has featured similar narratives of despair, with headlines proclaiming the end of the bull run only for prices to defy expectations and reach new zeniths. The 2021 cycle, for instance, saw multiple deep drawdowns exceeding 30% before the final parabolic advance. Similarly, post-halving periods have historically involved consolidation and retracement phases that weed out speculation before delivering substantial gains to patient participants. In the current environment, the recent halving's effects on minor economics and supply issuance continue to unfold, gradually tightening the available floating supply. Combined with growing network fundamentals, such as increasing transaction volumes, expanding Lightning Network usage, and heightened developer activity, these elements suggest that Bitcoin's intrinsic value trajectory remains firmly upward. Delving deeper into technical analysis, Bitcoin's price action reveals critical levels that traders and investors should monitor closely. The $76,000 zone has emerged as immediate support following the breach of $77,000, with stronger historical support clustered around $74,000, and further down, the psychologically significant $70,000 mark. On the upside, resistance awaits near the $79,000 to $80,000 range where previous rejection occurred, followed by the all-time high territory above $100,000 that many anticipate will be challenged later in the year. Moving averages, including the 200-day simple moving average, serve as dynamic battlegrounds where bulls and bears contest control. Volume profiles indicate that the recent decline was accompanied by elevated trading activity, typical of capitulation events that often mark local bottoms. RSI and other momentum indicators have entered oversold territories on shorter timeframes, hinting at potential relief rallies if macroeconomic conditions stabilize. However, a daily close significantly below $75,000 could invite further downside testing, underscoring the importance of risk management and position sizing in this environment. Beyond price charts, on-chain intelligence provides a more nuanced picture of market health. Metrics such as realized price, spent output profit ratio, and entity-adjusted supply distribution reveal that accumulation by large holders persists even amid the dip. Whales and institutional entities have continued selective buying, viewing volatility as opportunity rather than threat. Exchange inflows, while elevated during the liquidations, have not translated into sustained distribution patterns that would signal a major trend reversal. Instead, coins appear to be moving into cold storage or self-custody solutions, consistent with long-term holding behavior. The MVRV ratio, which compares market value to realized value, sits at levels that historically precede recovery phases rather than capitulation. These data points reinforce the narrative of a healthy correction within a broader bull market, rather than the onset of a prolonged bear phase. At CryptoHub, we emphasize the distinction between noise and signal. Short-term traders may focus on hourly candles and leverage dynamics, but the transformative potential of Bitcoin lies in its role as digital scarcity in an increasingly digitized world. As nation-states, corporations, and high-net-worth individuals increasingly recognize its properties as an inflation hedge and geopolitical neutral asset, demand compounds over time. Recent examples of countries exploring Bitcoin for trade settlement and central banks monitoring its evolution highlight the asset's growing systemic importance. Moreover, technological advancements such as improved scalability solutions, Privacy enhancements and integration with traditional finance rails expand Bitcoin's utility, attracting new cohorts of users and builders. This ecosystem development occurs irrespective of daily price movements, building a foundation that supports higher valuations in the medium to long term. The question at the heart of today's discussion, is this the final shakeout before the big pump, deserves careful consideration rather than hasty affirmation. While no one possesses a crystal ball, the weight of evidence leans toward optimism for those positioned strategically. Liquidations have cleared excess leverage, creating a cleaner slate for genuine buying interest to dominate. Sentiment indicators, including the Fear and Greed Index, have dipped into extreme fear territory, a contrarian signal that has preceded major reversals in past cycles. Institutional players, less prone to emotional selling, stand ready to deploy capital at attractive entry points. Corporate treasuries, having witnessed Bitcoin's performance through previous volatility, are more likely to increase allocations rather than reduce them. Furthermore, potential monetary policy easing later in the year, should inflation metrics moderate, would provide tailwinds for risk assets, including cryptocurrencies. It is worth examining comparable periods in greater detail to illustrate probable pathways forward. During the 2017 bull run, Bitcoin experienced multiple 40% plus corrections before ultimately surging to its then all-time high. The 2020 cycle featured a devastating drawdown triggered by external shocks, yet recovered to deliver returns exceeding 300% from the lows. In each case, the shakeout phase served to consolidate gains, improve market structure, and attract fresh capital. 2026 appears positioned for a similar trajectory, albeit at a larger scale given Bitcoin's increased market capitalization and mainstream integration. Analysts projecting targets between 150,000 and even higher cite the combination of supply shocks, demand growth, and network effects as key drivers. While interim volatility remains inevitable, the probability of a significant upward resolution increases with each passing month of institutional accumulation. Risks, of course, must be acknowledged transparently. Prolonged geopolitical instability could sustain pressure on risk assets. Regulatory surprises, though less likely given recent positive momentum, cannot be entirely discounted. Macroeconomic data releases, particularly inflation figures and employment reports, will influence Federal Reserve decisions and, by extension, liquidity conditions. For retail investors, the temptation to chase leverage during uncertain times has proven costly, as evidenced by the recent liquidation cascade. A disciplined approach focusing on dollar-cost averaging, secure self-custody, and fundamental research offers greater resilience than attempting to time precise bottoms. Diversification across quality assets, while maintaining a core Bitcoin allocation, aligns with prudent portfolio construction in this evolving landscape. As we analyze the broader altcoin sector in relation to Bitcoin's movement, it becomes evident that market leadership often consolidates during Bitcoin dominance phases. Ethereum, despite its own challenges, benefits from ongoing upgrades and Layer 2 scaling that enhance its value proposition for decentralized applications. Solana and other high-throughput chains demonstrate innovation in specific niches, yet they remain sensitive to Bitcoin's overall direction. The total crypto market capitalization, having pulled back from recent peaks, now presents opportunities for selective accumulation, where projects exhibit strong fundamentals, active development, and real-world utility. However, the primacy of Bitcoin as the reserve asset remains unchallenged, serving as the benchmark against which all other cryptocurrencies are measured. Looking ahead, several catalysts could accelerate the anticipated pump. Continued ETF inflows, potentially surpassing previous records as more traditional advisors gain comfort with the product suite, would provide steady buying pressure. Corporate announcements of Bitcoin Treasury additions, following in the footsteps of pioneers like MicroStrategy, tend to generate positive sentiment waves. Network upgrades, halvings lingering effects, and potential nation-state adoption news represent wildcard events capable of shifting narratives rapidly. Even in the absence of immediate triggers, the gradual grind higher driven by organic demand growth remains a compelling base case. Technical breakouts above $80,000 would likely trigger short covering and FOMO-driven buying, propelling prices toward the psychological $100,000 milestone that many view as inevitable within this cycle. In synthesizing these factors, the current dip below $77,000 emerges not as a dire warning, but as a potential inflection point, the final meaningful shakeout that separates committed participants from the rest. Markets reward preparation and patience, qualities that have defined successful Bitcoin investors across its history. At Crypto Hub, our commitment is to equip you with the knowledge and perspective necessary to navigate these waters confidently, always prioritizing long-term value creation over fleeting headlines. The cryptocurrency journey is one of profound innovation and economic empowerment, where volatility serves as the mechanism through which ownership transfers to those who grasp its significance. As this episode draws to a close, remember that while prices fluctuate, the underlying technology and its adoption curve advance steadily. Whether this proves to be the ultimate low before the surge or merely another step in a longer consolidation, the strategic imperative remains clear. Focus on fundamentals, manage risk, and maintain conviction grounded in data rather than emotion. Thank you for joining us here at Crypto Hub, where professional analysis meets the dynamic world of digital assets. Stay informed, stay disciplined, and we look forward to updating you on the next chapter of this remarkable market evolution. Subscribe and enable notifications so you never miss our timely updates. This has been Crypto Hub, empowering your crypto journey with clarity and insight.